In this video, I'm going to share with you the 3 strongest reasons why our bull market is not over. So before you buy the dip or sell all your coins, please give this a watch because it may change your perspective. But first, let's roll the intro. I'll be honest with you, I'm pretty scared right now as a crypto investor. Perhaps you could call me irrationally fearful. That's why I still have some shorts open, even though they've been bleeding for the past few days. It's not just me though, everyone is feeling fearful. Just check out our trusted fear and greed indicator, which is showing levels of fear that we haven't seen since the summer of 2021. Remember, that's when we had that huge Elon plus China crash. Well, the reasons to be fearful this time are way different compared to last time. We are all worried about a bear market for one simple reason: macro. Basically, the Federal Reserve has been changing their tune lately, and instead of printing more money, they are tightening things up to try to battle inflation. And because of their actions, we've seen high-flying tech stocks sell off like crazy. And it makes me wonder if we're already in the early stages of a macro bear market, which, as you can imagine, would be terrible for all risk assets, including crypto. But I always like to look at both sides of the picture, so we're not just consumed by our 2018 bear market PTSD. That's why when I came across some good arguments from the bulls lately, I compiled them into a list that I want to share with you. There's 3 in particular that I think make up the strongest case for the bulls, and yep, one of them has to do with Nancy Pelosi. So for the rest of this video, let's dissect each one, and then I'll end with my personal verdict of bull or bear. Sounds good? Let's go. Alright, so the very first point is that the Fed's actions do not necessarily cause a bear market like we'd expect. And I got this from Jeff Dorman's ARCA article, by the way, so shout out to him, I'll leave his link down below. But he basically argues that the Fed raising rates and starting quantitative tightening is not bearish at all in the short to midterm. He shares this chart and points out that during the last period of rate hikes, which was between 2016 and 2018, markets were going up the entire time. It wasn't until the end of that period in Q4 of 2018 when hawkish statements from the Fed caused a big 23% drop in the market. And by the way, Jerome Powell chickened out back then and started lowering rates again, which is why the bull market resumed. If we go back even further to the 2004 to 2006 rate hikes, we once again see that markets rallied the entire time until finally dropping at the end of the hike cycle in 2007. What's the conclusion here? Well, basically it's not as simple as money printer stops so markets drop. Because based on Jeff's analysis, it usually takes a while, like a year or more, before the effects of Fed actions cause a recession. Personally, I never looked at the data before. My only understanding was based on the rudimentary memes of finance Twitter. So it was good to see the charts and stats laid out by Jeff in his article. Now, before I get to my second point, which is all about the crypto industry specifically, I want to give a quick shout out to our video sponsors, YouHodler. With YouHodler, you can stop passively holding your coins and start putting them to work for you. Just deposit your crypto or stablecoins into your YouHodler wallet and start generating income with them. And if you don't want to send crypto there, don't worry because you can convert fiat to crypto on their platform in seconds. Finally, they use Ledger Vault's custody solution to protect your coins so you can get maximum returns with minimal risk of hacks. If any of that sounds enticing to you, go check them out using my link down below. Alright, so the second point is that crypto in 2022 is way different from crypto in 2018. So our bear market PTSD may be fully unfounded. Jeff Dorman points out how the use cases, types of investors, infrastructure, and general adoption are way different today compared to 3-4 years ago. I mean, just look at the top 10 coins in 2018. Most of them were like 90% hype and 10% usage, whereas now they at least have a notable usage or activity. If we look at the Block's massive 2022 Outlook report, we see that stablecoins have grown to $140 billion. Total value locked in DeFi protocols has surpassed $250 billion. Wallet growth on Ethereum has reached 170 million unique addresses. And even the nascent NFT industry has reached $10 billion in volume traded. Then if we turn to the builders and look at Electric Capital's developer report, we see over 18,000 monthly active developers committing code across the ecosystem. And 34,000 new developers showed up in 2021. These numbers are both significantly higher than ever before. What this tells me is that we have real adoption and active building going on, and that makes our industry way more substantive compared to how it was before. What does that mean for the markets though? Well, one interesting theory that I've heard multiple analysts share is that 2022 will be a game of liquidity. So all the liquidity won't exit the crypto ecosystem, but it will just slosh around flowing from sector to sector. And there won't be any overall bear market like before, but perhaps we'll see sector-specific bear markets. Like some niches will rocket while other ones drop, all at the same time. I can definitely see that happening. I mean, if you remember DeFi summer back in 2020, all the blue chip DeFi projects were absolutely rocketing. But afterwards, if you plot their price action against ETH, they've been down only in 2021. And you could argue that DeFi has been in its own bear market for a while now. And this is just one example out of many that supports this sector-specific bear market / game of liquidity thesis. Anyways, my final point has to do with this lady, our favorite congressional trader, Nancy Pelosi, still being bullish. You'll probably wonder how that even relates to crypto, but hear me out. If we look at this chart, we see that Nancy Pelosi is one of the best traders in all of Congress. She's the #1 performing stocks trader on the Democrats side, and the second best options trader of them all. So the joke on Wall Street Bets is that Nancy is either a savant trader or has insider info. Why overthink things? Just copy trade her. That's why we saw Twitter accounts pop up with the sole purpose of broadcasting her trades so we can buy the same stocks as her. Anyways, her and her husband recently bought millions of dollars worth of call options in companies like Google, Salesforce, Roblox, and Disney. So the simple conclusion is that they remain bullish and are not scared of a macro bear market at all. Does she know something that we don't in terms of the Fed or Treasury policy? Maybe. But if Nancy is right, and her track record certainly shows that, then maybe we should just stop being idiots and buy the dip. So to recap, we discovered that the Fed's hawkishness may not cause a bear market like we originally thought. We saw that the crypto industry is so much more mature compared to before. And we know that Nancy Pelosi is all out bullish. So with all of those points in mind, what does this mean for my sentiment and my strategy? To be completely honest, I do feel a little less fearful than before. I would say I'm at a 50-50 bull versus bear level right now. You may think that's not really helpful, but before, I was at a 30-70 bull versus bear level, so it's definitely shifted quite a bit. But I'm still gonna keep a super close eye on the stock market, the Fed, and Nancy, because I believe they are a huge leading indicator of what's to come for crypto. In the meantime, while we're still around these prices for Bitcoin and other cryptocurrencies, I'll take a threefold approach for my portfolio. First, I'll lock in more profits as we go up. Second, I'll still use shorts to hedge strategically until we have a convincing breakout to the upside. And third, I'll slowly deploy my available cash into stronger altcoins that didn't drop as much during these past few weeks. The reasoning here is that if they hold their own while the market was weak, then they will likely outperform when the market recovers. Anyways, that's my plan and my verdict. What about you? Let me know what you think all about this. Also, this recent price action confirms that the stock to flow model is broken and invalidated. And I just want to say, I called it. If you're curious about my case against the S2F model, watch this video that I made before. Or watch this one if you want to learn about hedging during a bear market. I'll see you on the next one, and cheers.